Welcome to The Explainer. Today, we're digging into the really impressive performance of JustPlanning, a Japanese tech company that's quietly becoming the engine for one of the country's biggest industries.
So, let's just jump right in with the number that tells the whole story. For its third quarter, JustPlanning posted a massive 35.8% jump in year-over-year operating profit. That's a huge number. So the big question is, how'd they pull that off?
Now this chart here really gives us a clearer picture of that growth. You can see the sales growth on the left and that impressive operating profit growth we were just talking about on the right. I mean, both are showing incredibly strong performance compared to last year, which is just a clear sign this company is firing on all cylinders.
Clearly, the company is on a serious winning streak. But, numbers like these don't just happen in a vacuum. To really get the why behind the success, we need to zoom out a bit and look at the bigger picture, the market that they're operating in.
See, JustPlanning isn't succeeding by itself. It's thriving because the entire Japanese restaurant industry is kind of up against a wall. They're dealing with this really severe labor shortage, and at the same time, this urgent pressure to adopt modern tech just to stay efficient and competitive.
And this is exactly where JustPlanning steps in. At their core, they are a digital transformation company. They provide the essential software and the systems that restaurants desperately need to solve these very real, very urgent problems.
JustPlanning's strategy isn't about selling just one single product. It's really about creating a complete ecosystem of solutions that are specifically designed to tackle all the pain points of the food service industry.
And as they say themselves, their focus is on the cutting edge. They're using things like big data, AI, and the Internet of Things to build these next-generation tools. So think about AI-powered analytics that can predict a restaurant's busiest hours, or cloud software that automates all the inventory. They're basically creating a true one-stop shop for restaurant tech.
So, how does this strategy actually translate into their business? Let's break down the company's revenue into what we can call its four powerful growth engines.
This table gives us the full picture. You can see that 4 of their 5 business segments are posting fantastic growth in both sales and, more importantly, profit. Now, there is one segment, their own restaurant operations that they use for R&D, that's facing some headwinds, but the core businesses are absolutely booming. Their first and largest engine is their Application Service Provider business, or ASP. This is their core cloud-based software suite called Consolidated, and it helps restaurants manage everything from sales data and inventory to staff scheduling and payroll. It's pretty much the digital backbone for all their clients.
The second engine is System Solutions. This is where they get really hands-on. They build custom point-of-sale systems, they provide IT consulting, and they sell the hardware that restaurants need to run their software. It's really the perfect complement to their cloud services.
Engine number 3 is a big one, logistics. Here they handle the entire supply chain for restaurant chains, a service known as third-party logistics, or 3PL. And this division is just soaring, with profit growth over 31%.
And here's probably the most unexpected engine. You might not see the connection at first, but their fourth growth area is actually a solar power business. They operate solar farms and sell the electricity, which provides a surprisingly stable and profitable revenue stream that really diversifies their whole portfolio.
So, with growth this fast, you might be asking yourself if it's even sustainable, right? Is the company taking on a lot of debt to fund this expansion? Well, let's take a look at their financial health.
This number right here represents their equity ratio, and it's an incredible 90.2%. Now, to put that into perspective, a lot of healthy companies aim for a ratio of around 40 or 50%. A number this high is almost unheard of, and it really speaks volumes about their financial discipline.
And this just brilliantly illustrates how rock-solid the company is. It means over 90% of their assets are funded by their own capital, not by debt. They are growing using their own profits, which makes them incredibly resilient and stable.
Okay, so with a stellar quarter and an ironclad balance sheet, what does the future hold? Let's take a look at their outlook for the full year.
Despite the amazing third-quarter results, JustPlanning is holding its full-year forecast steady. Now, this isn't a lack of ambition. It's actually a sign of confidence. They knew the strong performance was coming, and they are right on track to hit their target of nearly 15% sales growth for the year.
And they are sharing that success. The company is also forecasting an increase in the dividend it pays to shareholders, from 10 yen to 11 yen per share. It's just another clear signal to the market that they are really confident in their long-term profitability.
So, when you put it all together, what JustPlanning offers is really a powerful blueprint. They identified a traditional industry that was in need, they built a complete ecosystem of tech solutions to solve its biggest problems, and they executed their plan with incredible financial discipline.
And that leaves us with a final, fascinating question to think about. We've seen it in food service here, but what's the next old-school industry that's just ripe for a digital revolution driven by data, software, and a company with a really clear vision?